Insurance premiums. The premium is what the policy owner pays to maintain insurance protection. It reflects the risk that the insured represents to the insurer. The greater the risk, the higher the premium. Premium factors. Insurance premiums are individually assigned to each policy as part of the underwriting process. While they are assigned by the insurer's underwriters, premium rates are developed by the company's actuaries, i.e., insurance mathematicians. Actuaries base life insurance premium rates on three factors. Mortality. This is the risk of death posed by the applicant. It is a charge. Interest. This is the amount the insurer can expect to earn on invested premiums. It is a credit. The mortality charge minus the interest credit equals the net premium. Expense. This represents the insurer's cost of doing business. It may include taxes and fees. It is a charge that is added to the net premium to produce the gross premium charged to the policy owner. Mortality. The mortality factor reflects the insured's risk of death. It is drawn from mortality statistics compiled by the National Association of Insurance Commissioners, NAIC, into a set of rates called the Commissioner's Standard Ordinary, CSO, table. Updated periodically, CSO tables essentially identify the chance of death at every age for men and women. 2001 CSO table. Life insurers today use the 2001 CSO table. In fact, policies issued since 2009 are required to base their mortality charges on the 2001 CSO table. Interest. Actuaries add an interest factor to their premium calculations to recognize the company's investment earnings. The interest factor works as a credit. The higher the assumed interest rate, the lower the premium, and vice versa. Expenses. An expense factor, sometimes called a load factor, is worked into the premium calculation. It reflects the costs, other than mortality, that the insurer expects to incur on the policy. In determining its load factors, insurers are generally guided by three objectives. Cover total operating costs, for example, salaries, benefits, commissions, and field expenses. Provide a safety margin to account for higher than expected mortality losses. Contribute to profits. Premium tax. A premium tax is a state tax levied on insurance companies when they receive premiums. It is imposed by only a few states. Most companies pass this tax on to their policy owners in some way, either directly or indirectly. Maintenance fee. Variable life insurers charge a maintenance fee to cover the costs of managing the complex investment element of the contract. Other premium concepts. The remainder of this lesson covers other concepts important to understanding life insurance premiums. Net versus gross premium. Determining the premium that is charged the policy owner involves two steps. Calculate the net premium, which is the insurer's estimated cost to provide the policy's benefits without accounting for the insurer's expenses, using the factors of mortality and interest but excluding the expense load factor. For single premium policies, this is called the net single premium. For periodic premium policies, this is called the net level premium. Calculate the gross premium that is charged for the policy by adding the insurer's expense load to the net single premium or net level premium. For single premium policies, this becomes the gross single premium. For periodic premium policies, this becomes the gross annual, or gross level, premium. Premium payment modes. In calculating the gross annual premium, insurers assume they will have the full premium for the full year to earn interest. However, many consumers prefer to spread their premiums out and pay them more frequently than once a year. To accommodate that preference, insurers offer policy owners the following premium payment modes. Monthly, quarterly, semi-annually, annually. For those policy owners who choose a premium mode other than annual, insurance companies add a modest cost to the gross annual premium to reflect lost interest and increased administrative costs. Example. To cover administrative expenses and interest lost due to spreading out the premium schedule, insurers add a fee to premiums paid other than annually. A policy that has an annual premium of $1,200 might charge the following premiums for those who choose to pay more frequently than once a year. A monthly premium of $108, a total of $1,296 for the year. A quarterly premium of $318, $1,272 for the year. A semi-annual premium of $624, $1,248 for the year. Level versus flexible premium payments. Traditional permanent life insurance policies have fixed level premiums. Most newer types of life insurance give policy owners flexibility in how much and when a premium is paid. Under a level premium payment plan, the premium is fixed and remains level over the policy's term. Policies that use the level premium method include whole life insurance and variable life insurance. Term life insurance, too, has a level premium for the duration of the coverage term. However, if the policy is renewed, the premium increases to reflect the insured's older age. Under a flexible premium payment plan, the policy owner can change the premium payment amount at will within a range set by the insurer. Depending on the policy owner can change the payment amount or frequency of payment. The policy owner can also choose to stop payments for a while and then restart them. Policies that use the flexible premium method include adjustable life insurance, universal life insurance, and variable universal life insurance. For your review. The greater the risk, the higher is the premium. Actuaries base life insurance premiums on three factors: mortality, interest, and expenses. Policies issued since 2009 must be based on the 2001 CSO table. The 2001 CSO rates reflect the mortality experience of the entire U.S. population for every age beginning at birth and concluding at age 120. The more interest the insurer can earn through its investments, the less premium it needs to charge. The load factor, expense charge, reflects the costs, other than mortality, that the insurer expects to incur on the policy. For those policy owners who choose a premium mode other than annual, insurance companies add a modest cost to reflect lost earnings and increased administrative cost.
Please. Surface, the insurance premium is a pretty easy concept to understand. It's the price that a customer pays to own an insurance policy. That's a good start, but to be ready for your licensing exam, you're going to need to know a little bit more than that. Specifically, you need to understand the three basic components of an insurance premium, specifically a life insurance premium. The life insurance premium consists of, first, a mortality charge. Now, this is the big factor that distinguishes your premium from my premium. The mortality factor is the basic cost of insurance that you reflect, the risk you reflect to that insurance company. It depends on your age, your gender, and to a certain degree, your health profile. But mostly it's your age and sex that determine your mortality charge versus the person next to you. To the mortality charge, the company adds an interest factor, and that's actually a credit. The company collects that money, they invest it, and they hope to earn some money on their investments. The more investment income the company can earn, the more it can decrease your premium. So the interest factor is indeed a credit. To that net premium, the mortality charge offset by an interest credit, the company adds an expense factor that covers everything from the company's overhead lights, the paper, your commissions, everything. That expense load added to the net premium constitutes the gross premium that the customer pays. Now, one other thing about premiums that I want to mention, and that's the role of some people in the insurance company's home office that work with all this. You will hear the term actuaries in your business, and you will hear the term underwriters in your business. Let's make sure we understand the distinction between the two. An actuary is an insurance company mathematician whose job it is to calculate, among other things, the company's mortality charges. Underwriters don't calculate mortality charges. They calculate the premium rates that apply to a particular risk using the mortality charges their company's actuaries have composed and applying to that charge various factors that the underwriter obtains from the application and other sources of information. So make sure you understand the distinction between the actuary and the underwriter in assigning premium rates and you'll be in a better position for your licensing exam.
Okay, so here is our quiz for this lesson. Which of the following is the actuary's first step in determining the premium charged? And I believe it is this one. Which of the following most accurately describes the basic function of the life insurance policy's net premium? Let's go with net premium up there. The net premium is the amount required to cover his promised benefits. The net premium represents the insurer's mortality charge. The net premium is the amount an individual pays to provide all the benefits promised. Net premium is the amount actually charged to the policy owner. Oh boy. I need a book. Alright, I don't know. Instead of these videos, I need a book. Alright, I'm going to guess on that one. Carl is a policy owner who prefers to pay premiums monthly rather than annually. How will Carl's insurance company adjust his premium to accommodate this request? He will add some money on there. I believe this is the correct answer. Divides the annual premium by 12 in the first policy year. Divides by reduces the amount. I don't think there's any reducing. Okay, I think it's the first one. I know they add a little fee in there. Okay, an actuary's calculation of life insurance premium rates, what effect will a higher interest rate assumption have on the premium rate? I believe it will be higher, I'm guessing. Alright, let's see how we did. 50. Alright, I got 2 wrong. Okay, the first one was correct. Good guess. And I only guessed that because sometimes if you look at the next question following on a test, it would give you the answer to the previous one. Because they clearly were talking about net premium in here, right? Net premium. So that's why I kind of changed it to gross to premium. So those are just some tips when you take tests. Sometimes that happens, not always, but normally they'll stay on the subject. In this case, they're talking net premium here. And the actuary's first step is to calculate the net premium. All right, so which basic function describes the net premium? Okay, so the net premium is the theoretical amount excluding the load factor, which would be needed to fund the face amount. A lot of terminology there. The amount paid by the policy owner is the gross one. The net premium is the amount required to cover the policy's promised benefits without accounting for the insurer's policy-related expenses. Okay. Kind of like when we get paid. We have a gross amount we get paid, and then they take all the stuff out, and it ends up being the net pay. If that helps you remember the gross premium and net single premium. Remember, the net premium is the final after everybody takes everything out. Alright, so this one I got right, which I was pretty confident on. They just divide the annual premium by how many months you need, and then they add a little charge. And it goes up for how many months you want different. We showed that in the video. If you need to go back and look at the video, go back and look at it. Alright, so question 4, premiums will be lower. In making life insurance rates, a higher assumed interest rate would lower a premium. Wow, that's shocking. Okay. A higher assumed interest rate would lower the premium. Okay. Alright, that's the end of this video. I appreciate everybody. If you are following along, producer responsibilities will be next. And I'll see you then. Please subscribe.